Hello, welcome to Any Answers Answered for April 2024. Both questions this month come from the budget speech, or rather are related to the budget speech of Jeremy Hunt. We start, Tim, with a question from Gone Sailing. And Gone Sailing asked the question about sole traders to limited company. And they say 6% Class 4 national insurance, no Class 2 national insurance, with a dividend allowance dropping to £500, is it really worth, well, as I'm reading it, they're saying, is it really worth incorporating any more? My question would be, was it ever worth incorporating?
Well, it was worth it maybe 4 or 5 years ago for quite a lot of sole traders, but the changes that have taken place in recent years, and the poster of this question, Gone Sailing, does reference the national insurance contribution changes, the dividend tax allowance change, doesn't, I think, mention the corporation tax, or maybe they do, but of course we've got the small profits rate, but for larger companies, for marginal companies, a 26.5% corporation tax rate. All of that really does make it a far less likely case that you would incorporate purely for tax purposes. I should say what often needs to be said, which is that we should not allow the tax tail to wag the commercial dog. But there are, at the time of recording this answer, over 1,000 viewings of this particular Any Answers question, not surprising. And the first of those makes a general observation. They'd be nervous, says David X, about changing a business structure purely for tax purposes unless the benefits were significant. But also they make the political point, would you do this in the months before a new government will almost certainly be elected? And I think that is a very important point. Gone Sailing does make the point again about the tax dividend. And then there are various further comments in the answers to this question. One says there are significant savings to be made for a company, particularly with uneven business models like property development, but making the point, and I think this is a good point by was DKB-Sheffield, that if you're going to be retaining significant profits in the company, then incorporation is still going to be worthwhile. And that is a good point. Suppose the business is one generating very significant profits above what the business owners need to take out to maintain their standard of living. So it may be that the business is producing, let's say, £500,000 a year, but the individual only requires a couple of 100,000 of that to maintain a very nice standard of living. Well, by incorporating, they can retain profits and quite possibly realize those profits at a later date at a very low capital gains tax rate. But again, there is the political risk on that. So the fundamental answer is that probably not worth incorporating at lower levels. It hasn't been for some time, but there are many other factors to consider. Don't let the tax tail wag the commercial dog, but also don't forget about the possibility of retaining profits, sheltering profits at corporation tax rates, despite the increases, relatively low corporation tax rates within a company, rather than paying at higher rates. And one final point, Giles, on this is that if you're a Scottish taxpayer, the increases in the Scottish tax rates on non-savings income might, for higher income sole traders and partners, prompt them to incorporate because of the higher tax that applies.
And there's obviously added complexity in various places. You know, you talk about Scotland, and then I think Scotland are up to 412 different tax bands now. So clearly that's a much more complicated question. We have to factor in whether you're going to take the money out of the company or leave the company with all the money and only live on a relatively low share of the profit. You have to think about the other commercial reasons for why you might incorporate. But I think fundamentally, we're looking less and less likely to want to incorporate. There is this weird kind of perfect storm of factors around about the sort of 80 to £120,000 mark, where you've got the abatement of personal allowance to deal with. You've got the issue relating to, obviously, if you've got two associated companies, that band then falls to £125,000. You've got a whole range of different things to think about in certain areas, but it has to be an overall decision, is the point that we're making. But as I say, fundamentally, I suspect for most smaller businesses, we're probably looking at not pursuing the incorporation model in the future, purely from a tax perspective. Another question that comes up quite a lot is this question that comes from Carol McCare. Carol's question relates to the news that Jeremy Hunt gave us that FHL would be abolished from April 2025. And of course, we're looking at losing the interest relief rules, capital allowances, capital gains tax, pensionable income, all that sort of thing. The question she asked, though, fairly fundamental. Client has a small property purchased in 2009, which has been trading as a furnished holiday let since that day. The property is currently valued at £130,000, purchased for £95,000. The client intends to keep renting the property as a holiday let for a few more years, after which she may well move in or sell it. Currently, we'd be looking at a tax rate of 10%. Following the budget, it will be 24%. Another budget change for us to pick up there. No mortgage. Should my client transfer the ownership to a limited company, thus crystallising the 10% capital gain ahead of whatever happens in the future? Tim, what do you think?
No, is the simple answer. All right, it all depends. But again, at the time of recording, there are over 5,000 hits on this particular question, a massive number. So many AccountingWEB members, viewers will be looking at this question, and the out of the blue abolition of furnished holiday lettings, which I gather was very much driven by the Airbnb problems that coastal towns have been suffering, although there is a collateral benefit as far as HMRC are concerned, in as much as the abolition of furnished holiday lettings makes the MTDSA requirements, the quarterly update return requirement, a little bit simpler, because instead of having to do a separate quarterly update return for ordinary lettings and a separate one for FHLs, all the property lettings in the UK will be in a single quarterly update return. But getting back to the question, should we incorporate an FHL? Well, it would, of course, crystallise again, possibly at 10%. And as one of the first commenters, Paul Crowley, states, what if she chooses eventually to live there? What if she lives there until she dies? Then there's no capital gains tax. So the idea of incorporating is not actually that clever at the moment. And Ivor Windy Bottom made the point that the revenue or the Treasury announced on budget day that there will be anti-forestalling legislation, because it's quite a long run-in to the abolition of FHLs. It's nearly a year away from April 25. That gives taxpayers a lot of time to forestall the effect of this, and there will be anti-forestalling legislation. And it's very likely that the 10% capital gains tax rate simply won't be available if you incorporate an FHL now. That basically is going to be the problem. There could be stamp duty, land tax. Although there have been over 5,000 viewings, there are only a handful of comments, but I think basically that's because most would recognise that this idea of incorporating an FHL is probably not a runner. Caroline Miskin, who's the Senior Technical Manager at the ICAEW Tax Faculty, says, and one of the posters copied and pasted this, it'll be interesting to see whether this change does encourage landlords to move to longer term lets. It does appear to be a simplification of the tax system, but there could be disputes and tribunal cases over whether a lettings business constitutes a trade, because an FHL does provide often some other services that could anyway mean that the landlord is operating a trade. And Caroline also goes on to mention, as I've done, the secondary benefit for MTD. So that's it. Probably not, almost certainly not, is the answer to the basic question, should you incorporate an FHL?
If you want to hear more about the budget, then Tim and I discussed it in quite some detail in this month's Tax TV. But if you want a huge summary of it, I think the answer is yes, an awful lot of bits and pieces changed, but probably steady as we go for now. We don't want to jump too quickly, potentially jumping out of the frying pan and into the fire on an awful lot of these pointers. So the message for today is steady as she goes, and keep an eye on whatever we're talking about in the future, and also Tax TV to see what else might be important in terms of budget developments. For today though, that's all. Bye-bye.